You're listening to Fund Shack. I'm Ross Butler, and I'm here at the SuperReturn conference in Berlin, the capital of private capital, with José Luis González, Managing Director at Neuberger Berman, where he covers private markets, primary fund investment, and co-investment. José Luis, welcome to Fund Shack. You've got a very broad perspective of private markets, so I'd be really interested in how you view the situation out there in 2025 at the moment. How would you characterize it?
Well, of constant change, definitely. We ended 2024 with very high hopes and expectations that deal making was going to reactivate significantly. 2024 actually was already a better year than 2023. And that was the case for the first quarter of the year until there were some macro and political events,
I noticed.
Very well known, that generated a lot of uncertainty. And like in many other businesses, private equity is not immune, and transactions are not immune to uncertainty. And that's the last thing that investors want. So there has been sort of a pause and a halt in the pace, and definitely expectations for the remainder of the year are lower than anticipated. However, I also want to say that it's not that the world has stopped completely. There are still transactions happening, and there are still exits happening out there, but in very specific sectors. Perhaps Europe is more active than US on relative basis, and definitely compared with prior years. And yet to be seen how it's going to be the second half of the year. But if I were to do an estimate, is that it's going to be, knowing what we have known in 3-4 months, it's going to be an up and down all the time.
Sure. So we're really talking liquidity problems, and everyone that gets into private markets knows that it's illiquid. But that's a relative term, and eventually they want their money back. I guess challenging situations bring forth like innovations.
Yes.
So are we seeing innovations in the market to try and ameliorate some of the real illiquidity that we're seeing at this point in the cycle?
There are a number of innovations in the market, but some of them are also traditional solutions that they are being used at its best, I would say. So for example, if you think about secondaries, secondary funds are now in high demand, I would say, and they are quite busy. Our colleagues on the secondary team, they are quite busy. And together with that, there is an innovation within the secondary market, which have been the continuation vehicles, which is you don't need to necessarily provide liquidity to the LP. You can provide liquidity to the GP, that they want to hold those companies for longer and continue with the value creation path. So let's create a synthetic, if you will, fund to hold those assets. So that has been, I would say, one innovation together with a traditional focus.
And you're a fan of those?
I think there is a lot of value choosing the right ones, like in everything. Fundamentally, there are a lot of companies that they have a growing path in front of them. And the current environment, as we just said 1 minute ago, is not the right one probably to do a successful exit. Yeah. So instead of selling at a lower price and then having to redeploy that capital on who knows exactly what are you going to be able to buy. Yeah. It's much better if you can buy an asset that you have managed, that you know what are the prospects, and likely that it's going to be successful for you. Yeah. In addition to that, other innovations or things that, at least at our firm, we're doing, on the co-investment side, we're also providing liquidity in a different manner. So not necessarily by taking assets out of the fund, but injecting capital either into the companies of a fund or partially to the manager. So we're talking about buying, for instance, a 10% or 15% of a portfolio company in order for that manager to provide some DPI, some realizations to their LPs, and also crystallizing a value. Or when a manager wants to buy that asset from another fund, there's an evident conflict of interest. So there has to be a third party valuing at what valuation that asset goes from one fund to the other fund.
So the funds managed by the same manager?
Funds managed by the same manager, correct? Not a third party manager. And there, because it's not technically a secondary, is not technically a continuation vehicle, because it's actually a new fund that is going to deploy capital in new companies. But they're going to buy one asset from a predecessor fund. We help in the setting the valuation. We come in and say, look, we would buy it at this valuation. And then that valuation is used internally for that transfer of assets. So there are multiple ways where we are providing solutions and liquidity to the private equity environment. So
So just off camera, you described that first example. I think you called it a midlife co-investment.
Co-investments. We call them midlives because the original acquisition has already happened.
Yeah.
And now there is another event.
Is that your term or is it an industry term? I've not come across it before.
I think it's our term, to be very honest.
I like it.
But because it's midway the life of an investment.
Yeah.
We have been coined that term for a while. I'm not sure if it's industry-wide adopted, but we use it all the time.
What about the practice? Is that relatively common?
I believe we're one of the very few players that is able to do such a wide range of capital solutions, specifically in this type of transactions where the asset doesn't move from a fund, or if it moves, it moves to another fund of the same manager.
Yeah.
I think we're very one of the very few that is able to do that because it requires actually rolling up your sleeve and do evaluation and actually negotiate with the GPs what is the valuation. Whereas on other type of transactions, it's a price or a discount and then it goes somewhere else.
Yeah, I was going to say it requires a lot of confidence and conviction because you're certainly not investing in a blind pool. You're not even investing in a diversified pool of known assets. You're investing in individual assets. You've really got to have the mindset of
a buyout shop almost. And most of the people at Neuberger in the private equity side, we come from buyout shops, so we speak the same language.
Yes.
So when we come to the table, we know what matters to them and what are the levers that we can use to help them.
What does deal flow look like at the moment? Are you seeing attractive opportunities?
So that's a very interesting question because what you would see in the official reports is that M&A or number of transactions are coming down. But those transactions only look at part of the market. And as we just described, we operate in a part of the market that is not announced, right? These midlife transactions are not public. Yes. If you go to the website and you say Midlife and Neuberger Berman, you will not see many investments. But actually, we're closing several investments per month.
Do the data providers not even capture this stuff generally?
No, they don't.
Really?
They don't. So that's why when sometimes we speak with our clients and we say, look, we receive approximately 800 deals per year, and it has been growing over years. Yeah. They say, how is that possible? If the market is coming down? It's like, well, precisely because the IPO market is shut down. Because they're not able to sell their companies. There are new opportunities for us for that midlife co-investments, for instance, which it's, there is no ranking, there is no list where you can see those transactions and nobody's tracking them. So for us, deal flow is very compelling right now and very good perspective in that sense. So this volatility, to a certain extent, benefit us because we can be even more active in providing these type of solutions.
Yeah, there's an old-fashioned view of fund of funds, which is that it gives investors an entry point into the asset class and gives them access. But actually, what you're describing is the real value of understanding the market deeply. You can exercise your real strategic options and play tactically into the cycle.
Correct. And we're well capitalized because we have been doing this for a couple of decades already, and we have exited close to 200 investments today. I mean, since then. So we have it in many, many times and more than 22 billion deployed. Yes, on co-investments, for instance.
So we're just about to start an emerging managers series on FundShack. Do you invest in or look at emerging managers or let's say kind of new strategies within existing managers?
We do. We actively do. We have dedicated pools of capital and dedicated limited partners of ours that gives us an SMA and said, please choose what you think are the best emerging managers. And each of them, they have their own definition of what is an emerging manager, right? There are some of them that they say, look, they can have more than 2 funds. Some others, they say, look, they have to have prior experience with fund managing, right? So if they have not managed a fund before, it will not qualify as an emerging manager, but then it's an emerging manager that has already the experience managing a fund, right? But yes, we do invest. It's not the largest portion of what we do, but we have been doing that for already quite a while, and it has been a fairly successful program. And actually, some of our oldest relationships started like that. And then some of these shops are multi-billion shops today. But maybe 15 years ago, they were emerging managers.
So is the rationale for an emerging manager quota, or wrong word, mandate, is the rationale the risk return of that program, which was the word I was looking for, or is it a strategic play so that you're in with people who could end up being highly sought after?
Yeah, I think they're both. There's definitely an opportunity in these new managers. They're hungry and they're smaller by definition. They can tap into a part of the market that is not as well covered as probably the I don't know, large cap space, which there's more competition and highly sophisticated competition indeed. But at the same time, there is some strategic value to that, because if you accompany them, if you support them on their very first fund or even the second one, you can be a backer. Then if they are very successful, then in fund 4, fund 5, fund 6, they're going to be oversubscribed. Yeah. But they will always remember that you were there the first day.
There's an emotional attachment there. I have the same thing with my early clients.
Similar to that. So actually we are in very large funds today, and we have privileged access today thanks to those relationships of 10, 15 years ago when they were not so big or well known.
Private wealth is an emerging distribution channel for private markets. Is that something you're looking at?
We're definitely not looking at it. We have been active for over a decade right now. We have the advantage of being in as part of a larger firm that has the traditional background of fixed income and equities. So when it comes to which, those funds are for end clients, for wealth. So when you apply the same logic, the same operations to private equity, we have the investment side, and we share the same investments that we do for our institutional investors with a wealth channel, and you package it in the right structure, then you can deliver the good service that we're already doing with the, if you will, with the return profile of private equity. And as such, we have several closed-ended funds, but right now the demand is more on the Evergreen space. Because it's more user-friendly. And if you think about it, it's similar to a mutual fund. It's similar to investing in whatever fund that you want, or even an ETF, right? That you put all the capital to work. You don't need to wait for capital calls. You don't need to reserve cash over there. You have monthly reporting. You know how much it's worth every month. You don't need to wait for 3-4 months to get the report. So we're seeing significant demand. We launch a number of evergreen funds focused on private equity. My personal, if you will, forecast is that in 3 years, in the wealth channel, and again, this is not just retail. They are not retail. These are investors that are relatively sophisticated, high net worth. I would say that half of them, they will have a evergreen product in their portfolios in 3 years from now. Could be in private equity, could be infrastructure, could be in credit, but they will have one.
You heard it here first. What do you think the level of understanding and knowledge is in the high net worth community about these products at the moment?
I think it's, it varies by market and by wealth provider. There are some wealth providers that they have been doing this for a while and they have educated their customer base. So those clients are, if they're more used to this language. And there are some others that they are tipping their toes into it and they're asking us for help. It's like, okay, how should we do this journey? So we definitely have the full range into it. But what is clear to us is that everyone knows that they need to have a presence or at least an offering with evergreen private market solution because it's out there. It has the 2-3 critical advantages over public markets and closed-ended funds, which is user-friendly, right? You just commit, you send the money, and it's fully invested. It's diversified from day one. Low volatility, low correlation with all these oscillations in public markets. And then you get some potential liquidity, which is something very important to educate the clients, because in the end, these are illiquid assets as we started. So they should not think that just by putting a structure, you can make illiquid liquid. That doesn't
That's what I was getting at with my question, whether they really understand that. And also the fact that whatever liquidity you have, you effectively end up paying for.
Well, paying for
because you need it because you need it in more liquid instruments.
More liquid instruments, which are they yield less return. But that sacrifice of return, if you will, I think it compensates the luxury of being able to be invested and have the option to have some liquidity. still, most of the products out there, they're giving double-digit returns with very little volatility.
Really?
So if you ask most of the people, say, hey, you want to have 10+% per annum something with some chance of getting liquidity out and it's going to be fairly stable, I think most of the people, they say, okay, tell me more about that.
But how would you characterize the risk of those portfolios, though? Not just the volatility, but the risk of loss?
I think they're very diversified. I think the risk of loss is very low. Of course, there will be individual losses at the portfolio level, but at the overall level, I think it's relatively low. And definitely you will not have this volatility that the S&P had this year. Suddenly you are -10 or -15, and then suddenly you are +6. Everything in 5 months. Probably you're going to have a stable +0.5, +1% per month to go to that 10+% in these funds.
Yeah. I've got a bit of a hobby horse about risk in the industry because everyone obviously wants to talk about returns. They're obviously very cautious about downplaying the risk from a regulatory perspective. And so the risk either gets exaggerated or just not mentioned. And I think, well, that doesn't do anyone any favors.
Nope, exactly.
So thank you for answering my question. One thing we haven't touched upon is we're obviously in Europe. You're based in Madrid.
Yes, that's right.
What's your view from a private markets perspective on Europe versus America, if that's not too contentious a framing?
The US market, North American market, has been approximately 60% of deal volume and activity. It's just the largest market in the world. And right after that, it's Europe. And to be fair, you have to go to the old concept of Western Europe, because Eastern Europe doesn't have much private equity activity. And then way behind that, and it's already a big behind the US, you have Asia, because Asia is a very fragmented market, although it's huge, it's gigantic. Those are the 3 main markets that I see. So the US right now, they are coping with a lot of uncertainty.
I noticed that.
But it's fair to say that the typical sectors where currently private equity focuses on, or over the last decade after the GFC, are not in sectors that they are very prone to be subject to tariffs. Why? Software. How do you actually put a tariff on a software, right? Or services. If you are providing a service, those are naturally the sectors where private equity is investing on. I mean, there are some investments in industrial sectors and they get impacted, etc. But it's a very small portion of.
There aren't many steel mills that are private equity.
Exactly. Now, what is happening in the US? Obviously, the bid and ask spread is widening, and then that is pausing the deal making. Whereas in Europe, it seems that we are having the opposite. It's like, hey, here we have a stability. Let's continue with our business. So the expectations that we had at the end of 2024 haven't changed actually as much in Europe. And at least at our level, we're seeing more volume on a relative basis in Europe than in the US compared with other years, which it's like everyone says, it's about certainty on the rules of the game.
Yes. Certainty, very important. But there is another way of looking at it, which is, okay, certainty carries a premium. But what about the fundamental return environment in Europe compared to America over the medium to long term?
Yeah, that's a good question. Return of European investments, if you compare good managers against good managers in the US, they're about there.
Right.
Now you need to choose them, and they have more difficulties than in the US. In the US, is a very large market. Europe is also a very large market, but it's not the same Germany than the UK than Spain, right? So you need to play differently, and you have the local languages and the local regulation, despite being, in theory, in the same European Union, etc. So I would argue that it's a little bit more difficult for European managers to achieve the same returns in the US, because the market, yes, it's same size, or you can make it international, but you need to work extra to it, and regulation is a little bit heavier here.
Yeah.
And probably in the US, they have fewer holidays, so they have to work more.
That's true.
So they get more deals done.
Yeah, I take a slightly lower return and keep my holidays. José Luis, thank you so much for sparing your time for Fund Shack. Great chatting with you.
Thank you very much for having me here.